Hey everyone, Chris Johnson of Monday Morning, and today we're talking about Apple earnings. They're coming up next week, but I think you need to start preparing right now. When I look at the three components of a trade that I monitor, this lines up with something similar to what we saw in March of 2000, and that's right before Apple fell into a long-term bear market that took 80% of its value. Whether you're a bull or a bear, this is going to be valuable information with you, so let's take 10 or 15 minutes and jump into it right now. All right, I've already given you the punchline here. Apple is starting to look like it looked back in March of 2000, and it's got a big red light going off on my computer monitor. This is a situation that lines up all three components of a trade, and they work both ways. I'll explain them real quickly here. First of all, I always like to look at the fundamentals of a company, what the company's doing to make money and whether that's going well. Number two, I always like to look at the technicals. If you don't watch technicals, in other words, price charts, you're missing a big part of the picture, especially in a market like this where traders are moving tons of money around based on the technicals. You need to be watching the charts. Third is the sentiment for a stock. What the Wall Street analysts are saying, what investors are feeling. I want to determine whether this is a crowded trade or not, because if it's crowded, there's more selling potential. All three of those components right now line up the way they did for Apple when it did this right here. This is the 2000 bear market. And of course, we had the run up, and right now you can make all kind of arguments about whether we're in a bubble in AI. This is what a bubble looks like. And in this case, it was on Apple stock. Now, let me explain what was going on back then. This was a small computer company, right? It was kind of battling it out with Microsoft and some of the other PC companies at that time because we saw innovation in the industry. The semiconductor innovation that happened in the early to mid 90s enabled us to have all these computers. It started to make us more productive, etc. And that's where Apple started to take off. And this is split adjusted, obviously. It's not trading at $1 back then, but to that top that we saw in March of 2000, you had positive technicals that were going into that situation that started to roll over. And when we look at the daily chart in just a minute, you're going to see the rollover that I'm talking about. But the fundamentals were a little unclear here as well. Remember, fundamentals, technicals, and sentiment. So let's talk about what was going on in that 1999 to 2000, kind of resting on their laurels a little bit. They had the Mac. They were trying to develop and get into other areas of the market. Really wasn't going on. And that's when Apple started putting money into capital expenditure, research and development, and they were trying to come up with new products. That was going to be the key. If you're looking at technology stocks, there's a difference here. And I can name a couple of these and you'll understand immediately when I tell you about them. But if you're innovating, you're going to be okay. If you're coming out with good products that are going to market and they're new products, innovating, then that is something that is going to make you fundamentally strong. Revenue, earnings are all going to follow. Again, innovation is key. There's another side to that, which is iteration. And what that is taking an innovation, just putting out a version 1.2, 1.3. Microsoft did it, right? Microsoft did it for a long time with Windows. And they suffered after they stopped innovating. It caused them to go out and go to subscription models with Microsoft Office, etc. And then obviously we lead into AI now. Innovations that made changes in Microsoft. Microsoft has recently been innovating with AI. Now, think about Apple as a comparison here. Back in 2000, they weren't innovating and they started putting money into new product development, but it was too late. The dot-com bubble was grabbing every stock out there and tearing it apart. At the same time, the company was rolling over. So from a technical and fundamental perspective, there was a warning sign out there in 2000. The third thing that was part of this component right in here was sentiment. And back in 1999 and 2000, we saw sentiment off the charts for Apple stock. You had 97% of the analysts recommending it as a buy. You had Wall Street estimates for target prices that were going through the roof. Everybody loved Apple. And it's nothing compared to how much they love it now, right? What do we see? We saw an 80% decline in the stock. And then what happened in 2001, 2002? Innovation started to lead the way again for Apple when they came out with the iPod. You remember the old clunky iPod that you could well, you can put in your pocket really and carry around and listen to your music, 1,000 songs, et cetera, et cetera. They started making iterations of the iPod all the way through 2006, 2007, and it turned into billions and billions of revenue. But they were still iterating. The next innovation came along the way with the iPhone, and bam, you got a product that's carried them all the way to 2024, let's call it this year, where it has accounted for more than 52% of its revenue. But that revenue has been tailing off. Why are they in trouble now? They need an innovation. And when you look at the innovations that are out there right now for the iPhone manufacturer, they are few and far between. I've been looking around at some of the websites that kind of have the inside track on what products are coming from Apple and what to expect over the next year or so. You know what it is? It's a list of iPad iterations. It's a list of the earphones, my gosh, the AirPods. I can't even remember the name. I've got them. Watch iterations, and of course, phone iterations. The one that I thought was most interesting that's not even on the calendar yet is the foldable iPhone. So, what's that tell me about the fundamentals? It tells me that right now the fundamentals are not solid for Apple. They're going to pull a Meta here. And if you remember, Meta a few years ago announced that they started to innovate again in forming the metaverse. What happened there? The stock lost 70 to 80% of its value because they had to go into this deep dive to come up with a new product. Eventually, they had to call it stop, pull back the spending, and the stock started to move higher as they went back to their core again, which is advertising and AI. They had an innovation with AI moving into advertising. Their most recent earnings did well on an earnings per share basis. The stock traded 12% lower because they announced that they're going to do more CapEx into the metaverse. So innovation right now is going to be key for Apple. They have been iterating for too long. That makes the fundamentals weak. Now, second component we're going to look at right now is the chart. So I always tell you, you need to look at the charts. The charts are more important right now for Apple than ever. There's a saying or an analogy that I use when I talk about the technicals, and it applies to the market. It applies to individual stocks, almost anything out there. When the fundamentals start to fail, the technicals always take over. And I'll give you the analogy for that. If you know a pilot or if you are a pilot, there are two different styles of flying. Number one is you can fly by sight. You look out of the windscreen, the windshield, if you will, and you see the mountains coming. You see where you're flying, and you can adjust based on that. But when you head into a storm, you have to fly by instrument. You look at the panel. It tells you whether you're going higher or lower, whether you're going sideways. What it is, the instruments or the data that tells you how to fly at that point. With the fundamentals getting hazy for Apple, it's going to turn into more of a technical trade. And that is something that you can use on any stock. Whenever the fundamentals start to get hazy or cloudy or unclear, uncertain, always look to the technicals because that is going to guide your way, just like an instrument panel on a plane. Here's what the technicals are telling you right now. Now, what you're looking at is a daily chart for Apple, right? The green line is the 50-day moving average. I always use that. If you watch my videos, the 50-day moving average is the one line that you can look at and say, is the trend my friend? That is the trend line that embodies that saying. Since we saw the stock roll over in February, the trend has not been friendly for Apple. We've seen lower highs and lower lows, which is a pattern that any technician is going to start to take aim at and say, hey, this is going to see continued selling pressure. We also have this cross right here. And what you're looking at is a 200-day moving average. It's just the average of the closes over the last 200 days, as is the 50-day average of the closes over the last 50 days. But whenever your 50-day crosses over your longer-looking 200-day, that's what we call a death cross. Look it up. It's kind of a cool name, but the technical reference for that is a death cross. When it's going the other way and the 50 days turning higher, it's called a golden cross. You can guess what the implications of both are. 4 to 6 months when you look out, when you do technical studies on this, it tells you that the stock has usually around a 70 to 80% chance of trading and trending lower. So it's basically telling you that momentum has started to move against the stock. This is a bad situation for Apple, and we're seeing it in a number of other companies as well, trading below both that 200-day and that 50-day and the death cross. So, from a technical perspective, as we head into earnings, what does this tell you? It tells you that the short term is going to basically put things in control of the sellers. If we see Apple come out and beat on an earnings per share number, you may see the stock pop higher, but then you're going to see it start to roll back over again. You know what? A great example, and I don't want to get into the weeds, is look at Tesla shares. Tesla shares traded in a similar situation. The 50-day, the death cross. Now you can see the shares have popped higher after that earnings, and it wasn't the earnings that made it pop higher. It was instead the hope behind those new models coming in 2024, 25. But look at what's going to be there to stop the stock and start reversing again. Whenever you have the 50-day and the 200-day lined up on a company that's heading into earnings, I always, at best, sit on the side. And in many cases, it offers up an opportunity for the short. So if you're a holder of Apple right now, this is a warning sign, even for the next 4 to 6 months. But where does this chart get uglier? It's when we look at the long term. And when I say it looks and feels like March of 2000, this is why. This is the monthly chart of Apple. And when we look at it, you've got this green line, I've made it, and that is the 20-month moving average. This is the technical line that you watch to determine whether a stock is in a bull or bear market trend. And it's as simple as if you're above it, you're in a bull market trend. If you're below it, you're in a technical bear market. There's also a fundamental definition of a bear market, and that is that you fall 20% from the highs, and then you're officially considered moving into a bear market. Well, right now, with this pullback that we've seen, we're at an 18% decline. What's that mean? Any misstep right now in Apple's earnings has the threat of pushing the stock into a long-term bear market trend, just like it did back in March of 2000. Now, real quickly, just so I'm not saying, hey, let's compare apples to oranges or something similar like that, we've had 5 different major bear markets since 2000 in Apple. 5, if you go back and look at either of those type of definitions. 2001, you ripped off 80%. 40% again in 2008, 2013, 20, 2016, 20, and then 2021, you got down 30%. So you average somewhere around 30, let's call it 30% or so on these pullbacks. But each one of those bear markets, you saw a situation where the short-term technicals still and the long-term technicals still were in these upward trends that helped to bolster the stock. You also had the analyst community supporting the stock. And that's going to give me a great segue into the third component of this trade, which is the analyst community. So if you look back at 2000, you had 97% of the analysts that loved the stock. And we saw a similar situation in Apple a couple of years ago. Write this down because it's important. Whenever you look at the analyst recommendations for a stock and everybody's in that strong buy or that buy category, it's a sign that the trade is crowded. Now, there are other things that you can look at, option activity, a number of things, really, to get that sentiment. But one of the more effective ways and simplest is to look at the analyst recommendations. Are analysts upgrading the stock or are they downgrading the stock? And if they've peaked and they're starting to downgrade, it kind of tells you that cycle's over. Well, over the last couple of months, we've started to hear analysts talk about Apple and the need for innovation or new products, this type of let's go back to the roots of Apple that made it grow. And when the analysts start to get a little worried, you start to see a trend where they start to roll over. And you kind of see how we've seen that average the rating of the stock moving lower. But this is over the last year. When I go out and look at this over a 3-year period, we're still very much at that high level. So even though the last, let's call it 3 to 6 months, have seen challenges and some of the analysts saying, hey, I'm going to move from a strong buy to a buy, or maybe a few from buy to a hold, you still don't see anybody with the sell, and you're not seeing the target prices coming down. That's a sign that sentiment right now is still way too optimistic. So let me kind of add those 3 things up, and then we're going to go back to the chart and look at a couple of targets, and I'll give you the warning signs right now. So when I talk about the fundamentals, and keep them very simple here. But when we talk about the fundamentals, the company's in need of innovation. We've seen revenue starting to come down, year-over-year revenue. Earnings per share. Last quarter, we saw some questions around whether or not the company's going to continue to beat earnings per share. That is all getting a little bit hazy, right? It's not the solid foundation, the fundamentals that we need in order to say, yeah, I'm going to put $1 down on the stock today and get back $1.20 or $1.50 over the next couple of years. The fundamentals are lacking. When we look at the technicals behind the stock, I've shown you we're sitting on the edge of a bear market right now. We're also seeing the 50 and the 200-day moving averages that are pulling back and rolling over, telling us the momentum is turning negative on the stock. So the technicals right now are negative, and that's 2 strikes. That sentiment still remains relatively optimistic, and that is where you get into the real dangers here. Let's fast forward it a little bit and say that the company comes in and just meets expectations, or maybe they fall below on expectations and announce that they're going to start putting a lot more money into CapEx. It's going to be a situation where a lot of investors are going to get spooked, just like they did with Meta. Analysts are going to start downgrading the stock, taking it down from the strong buys to buys, and from buys to holds, and they'll start lowering their price target, and that's when you see that waterfall effect. And keep in mind that Apple is one of those stocks that I had. There's a value out there that's unspoken for. It's redemption risk is what I call it. There are so many people out there that are holding Apple. It is one of the most widely held stocks in the market. Still accounts for a huge portion of the NASDAQ 100. When you have a stock in that position, the redemption risk, so in other words, the risk of selling pressure coming into the market is much higher. And that's what you face right now as that extra warning with Apple. So how do I see all of that playing out when I have all 3 of those components of the trade pointing the wrong direction? Here's that chart of Apple again. Right now, we're just crossed below this $175 level mark. And you'll find that stocks that are trading above $100 usually go by $25 increments in terms of psychological support and resistance levels. That $175, we saw that the stock tried to bounce there a couple of times and is now broken below that. As we break through that 20-month moving average and below the 20% from the high rule in terms of moving into a bear market, you'll see pressure start to increase on the stock. And at that point, $150 turns into your intermediate term target. And when I say intermediate term target, that's within the next usually 4 to 6 weeks. If we have a bad earnings report, you can expect that to happen much, much faster. From there, you can see how $150 has historically given us, or the market, a little bit of muscle memory, what I refer to as muscle memory. We hang out at 150 a little bit, and then any pressures that are existing on the market or that trend continuing to build against Apple pushes the stock down to $125, which is where we saw it at 2000 at 3 in those bottoms. Now remember, 2003, it still had a lot of the analysts coming in and supporting the stock, and now you would have analysts going the other direction. Nobody's going to throw Apple out and completely get rid of it, but in this case, you're looking at a situation where we move from that 150 down to that 125, and then your next reasonable level of support is at 100. It's kind of like a play on Tesla right now. Whenever you get down to century marks on the price, that's where you're going to see overwhelming pressure come in and start pushing the stock higher. That's where the analysts start to see it as a true value play, especially if they're innovating. The other can stand true here as well. We can continue to see Apple not innovate and iterate, and I think that's going to just be a slow, long bleed on the company's price chart. So if you're a bull on Apple, take this as a warning. Watch that 20-month moving average. Specifically, you want to be watching somewhere around that $165, $160 mark. That's where you start to see more selling pressure come in on the stock, and it presses it down to $150. If you're a bear, this is an opportunity to possibly short the stock. You can use options. I don't recommend shorting stocks using margin accounts, but use options. You choose your expiration. I recommend this be something of a longer play and target that $125 mark. $100 is going to be that point where the stock sees blood in the street and you'll have buyers come in. That's part of that sentiment cycle where fear turns into absolute panic. And I think that's where you would see it kick in at 100 and where I would be a buyer of the stock at that point. Don't catch me wrong. I'm a long-term lover of Apple, and I've owned the stock for a long time, sold it last year, looking for opportunities to get in. And this is one of those points where you take a dollar cost average approach if you're a long-term investor buying shares like me, and you buy some shares at 160, at 150, 140, just pick the tens and buy it on the way down and build an allocation over time. But for right now, that price trend is definitely looking to take you much lower, and it looks similar to that March 2000 top that we saw. Hope this information was helpful for you. Make sure you like and subscribe so you get more from us here at Money Morning. And as always, until the next time, I wish you the best trading success.